Have you ever wondered how it's possible to invest in hundreds or even thousands of companies with just a single click? Well, today, we're pulling back the curtain on the powerful tool that makes it happen, the Exchange Traded Fund, or ETF. If you've heard people talking about ETFs but you're not totally sure what they are, you are in the right place. So, let me just ask you this. Do you want to invest in, say, the 500 biggest companies in the US? You could go out and buy 500 different stocks, one by one, but who has the time for that? Turns out there's a much simpler way, and it's exactly what ETFs were invented for. All right, so here's our game plan for today. We're going to start with the basics. What even is an ETF? Then we'll get into how they work. After that, we'll cover the 4 key advantages that make them so popular. We'll also put them head-to-head with mutual funds. And finally, because it's so important, we'll talk about the risks. Sound good? Let's dive in. Okay, first up, what on earth is an ETF? Let's get to the big idea behind this single, simple security. At its heart, an ETF is kind of a hybrid. Think of it like this. It took the best part of a mutual fund, which is pooling money to buy a whole bunch of different investments. And it combined that with the best part of a stock, which is the ability to buy and sell it easily, anytime the market is open. You really get the best of both worlds in one package. So, how does this actually work in practice? Well, the answer is kind of hiding in plain sight. It's right there in the name. Let's just break it down. First, you've got the fund part. This is the basket we're talking about. The ETF manager pools money from thousands of investors, just like you, to buy hundreds of different assets, stocks, bonds, you name it. Then there's the exchange-traded part. This just means your little slice of that giant basket can be bought and sold on a stock exchange, all day long, with the price moving up and down just like a share of Apple or Amazon. Now, here's the secret sauce. Most ETFs aren't trying to outsmart the market. Their goal is much simpler. They just want to be the market. They're built to perfectly track a specific index, like the S&P 500. This hands-off approach is called passive management, and it's a huge reason why they've become so popular. And that passive approach is really at the core of their appeal. But it's not the only reason they've exploded in popularity. Let's get into the why and break down the 4 biggest advantages. First, and this is a big one, is instant diversification. The moment you buy just one share of an S&P 500 ETF, you instantly own a tiny piece of 500 different companies. Your risk is immediately spread out. It's that old rule, don't put all your eggs in one basket, but made incredibly easy. Second, they're cheap. Remember how we said they're passively managed? Well, since they're just tracking an index, they don't need a huge, expensive team of analysts trying to pick winners. And that saving gets passed directly to you in the form of very low annual fees, or what's called an expense ratio. More of your money stays working for you. Number 3 is flexibility. This is a game changer. With some other funds, you can only buy or sell once a day after the market closes. With an ETF, you're in the driver's seat. You can trade it any second the stock market is open, giving you way more control to react to what's happening. And finally, number 4, they can be more tax efficient. Now, this gets a little technical, but the simple version is this. The way ETFs are structured means they usually don't have to pass on as many taxable gains to their investors each year. You generally only pay taxes on your own profits when you decide it's time to sell. Okay, so we've mentioned them a few times. How does an ETF really stack up against its older cousin, the mutual fund? Let's put them side by side. You know, if you remember only one single difference between the two, make it this one. ETFs trade all day long, like a stock, with the price changing constantly. Mutual funds, they get priced just once per day, after everything is said and done. That's the biggest difference right there. And that single difference in trading leads to a few other distinctions. You buy and sell ETFs right from your brokerage account, easy peasy. Mutual funds, you often have to go directly to the fund company. And because ETFs trade all day, they're generally seen as more liquid, meaning it's easier to get your money in and out quickly. But listen, no investment is a sure thing. To really have the full picture, we've got to be honest and talk about the potential downsides. So let's get a balanced perspective. First, and this is the big one, there's market risk. If the whole market goes down, your ETF is going down with it. Simple as that. Second, there can be something called a tracking error, where the fund doesn't perfectly mirror its index. You also got to watch out for trading costs, like commissions and the bid-ask spread. That's the tiny price difference between buying and selling. And finally, a huge word of caution. Steer clear of complex ETFs, like leveraged or inverse ones, unless you're a pro. They are way, way riskier. And hey, don't just take my word for it. US regulators like the SEC give this very clear advice. Before you invest a dime, read the fund's prospectus. That's the official rulebook. It lays out everything, the goals, the risks, the fees. It is absolutely your best friend. So, we end right here with this big question. Now that you understand what an ETF is, how it works, the good and the bad, you can start to really think about it. Is this powerful, flexible investment basket the right tool to help you reach your financial goals? That's for you to decide.